most federal government employees, upon retirement or separating from their service, they do know that they're going to have a pension. But how do you calculate that pension? Probably most people don't understand that. So we're going to dive into that. My name is Momodou Bojang. I spent over 2 decades helping hardworking federal government employees and their families so that they can make smart and confident choices about their retirement, and that way they can enjoy a profound one. So let's look at how your pension is calculated. Now, for federal government employees, in order for them to calculate, for the federal government to calculate your pension that you rightfully deserve, there are key things that they look at, 3 key important things that they look at. Number 1 is your high 3 average, right? What is the high 3 average? That's basically what they do is they go back and look at your work history. You work for 30 years, they look for 36 consecutive months, right? That's what they're going to take and then be able to, an average though, that would be your high 3 average. And then for most federal government employee, they attain that high 3 average towards the latter part of their career due to natural job progression and all that. But that doesn't necessarily mean that a lot of times it's true, because sometimes people could be in a higher grade level for whatever reason, family conditions, they might probably come down to a lower grade level, and that may they probably will reach their high 3 average during that time frame. So it doesn't matter when that high 3 average, but they're going to look at it and say 36 consecutive months. When did that happen? They're going to take those and then be able to average those and then be able to calculate what your high 3 is. So let's say, for example, they did that, they calculated and say your high 3 average is $100,000, just from a basic math point of view, okay? So that's your high 3. Now, they're also going to look at, like, the factor that they're going to calculate your pension. It's either 1% or 1.1% calculation. And then what makes it 1% or 1.1? It depends on when you retire. If you're eligible to retire, but then you don't have 62 years and then 20 years of service, then your calculation is going to be 1%. If you retire at age 62, but you have 20 years of service, then your pension is calculated at a 1.1% calculation. So in this scenario, for basic math, let's assume that this individual doesn't have the 62 years and then 20 years of service, but they're eligible to retire. So we're going to say their percentage is going to be 1%, okay? And then we look at, like, well, what's the length of service that this individual served this nation? Let's say they served the federal government for 30 years, which is profound, right? That's what I call a distinguished career. And then if you're a federal government employee out there, this is when I connect with you all. For 30 years, all what you do is you go to work, you don't complain, you show up and you do your job. You deserve this pension, right? So I feel you deserve this pension, right? So 30 years over here, so you do 30 years of service, okay? So now, how do you calculate your pension? They'll take your high 3 average, and you take that, like, 1% by 30, then that'll give you about what? $30,000 per year. So that means your pension comes down to $30,000, okay? Nice salary over here, and I always talk to federal government employees about this, and I said, look, regardless of how much you have in a pension, whether it's $30,000, it's $40,000, $60,000, guess what? That's a protected income. That income is going to come to you every single year for the rest of your life. You're not going to be able to outlive this. That is profound. I always tell them that if you and your friend, you work for the federal government, if both of you need about $50,000 in retirement to enjoy a profound retirement, well, your $30,000 is already done with your pension. You have to worry about what? The $20,000 difference. They have to worry about taking $50,000 out of their portfolio. So right there, you put yourself in a much, much better situation. So that's why pension is a great thing. Now, but that's great. But what I want you to also think about, well, what are the different sources of income in retirement? Now we know how your pension is going to be calculated. We have to think about, well, number 1, you're going to have what? You're going to have a pension. Okay? Number 2, what other source of income are you going to get? You are going to get Social Security. Okay? You can get Social Security coming in. Number 3, what else are you going to get money from? If you've done what you're supposed to be doing, put money into your TSP, and you're going to get TSP withdrawals coming in at some point. And then here also, maybe this Social Security over here, before you hit age 62, reach age 62, you're going to get the first supplement, okay? You get the first supplement, but that ends at 62, ends at 62, okay? So these are the pretty much your foundation. These are the three-legged stool that you're going to have upon retirement. You're going to get your pension, you're going to get Social Security, and you're going to get your TSP. Now, this is the problem. Is your pension taxed? Absolutely. Federal level, you have to pay tax. State level, if you live in a state that pays the state income tax, then you're going to have to pay tax on that. Do you pay tax on your Social Security? Most states don't tax Social Security, but from a federal point of view, you pay tax on Social Security. And your Social Security tax is between 0, or you could pay up to 50% of the benefits being taxed, or up to 85% of your benefits being taxed, right? Depending on how much money you make. So Social Security also is going to be taxed. And then if you have all of your money in the traditional TSP, is that going to be taxed? Absolutely. So this is very key for you to look at your income sources and then be able to factor in the taxes, because taxes could be a deal breaker over here. If you end up foregoing tax strategies, or you neglect it, but just looking at your TSP money to actually grow, you're going to end up in a huge tax trap over here, which that's why we always challenge people to say, you know what, you want to make sure that you understand the tax traps out there. That way you could do something right now to be able to escape those traps and then be able to pay your fair share of taxes, but also be able to keep more for your family and then or whatever aspirations that you have, right? So in a sense, this is what you have, and this is how your pension is calculated, right? You know, if you have any questions, reach out to us, right? So this is what we do. I'm going to encourage you to, if you see value in this video, the first thing that I want you to do is subscribe to this channel, because this is where we post timely information that are critical to your retirement, and that way you can plan and have a profound retirement, right? So the other thing that I would probably say, talk to your friends and family, because this is where, if they are federal government employees, this is where they're going to get the information that's going to make a profound difference in their life. So I hope you get some value in this video. If you do, congratulations, talk to your friends, and I'll see you later on in this channel, because I want you to come back and then get more timely information. All right? Bye.